Meta Platforms Inc. have just released their fourth quarter earnings for 2022 and the market is loving it. It's up almost $20 to $176 a share. What we're going to be doing today is going through these numbers, seeing why the market is reacting so positively towards this, and then we're going to be taking a look at my stock spreadsheet. We have the summaries of the stock, discounted free cash flow model, and the Graham's valuation model to see if Facebook or Meta, is a buy based on these earnings. Just to give a quick summary of what's happened to the stock over the last year, it has been a very bumpy ride. We'll even take this out a little bit further. Down from its all-time highs at $380 a share, down almost, what was that, 70%, 76%, and then has rebounded pretty strongly up almost 70%. So if you're bored at the bottom, it's been a great time. Can Meta get back to the highs? Well, that's the thing that we want to see today, but the market is liking what they are seeing. So before we get into it, please give a like on the video and subscribe if you're not already. Really helps me out. Now, this is the fourth quarter and full year results for 2022, so there's a lot to go through today. Let's just see what Mr. Zuck has said. Our community continues to grow and I'm pleased with the strong engagement across our apps. Facebook has just reached a milestone of 2 billion daily actives. That is crazy. The progress we've made on our AI discovery engine and Reels are a major driver for this. Beyond this, our management theme for 2023 is the year of efficiency. Let's see if that is true. We're focused on becoming a stronger and more nimble organization. It's all well and good saying that, but let's have a look at the numbers. So we have the year ended 21 and 22 here, and then we have the 3 months ended. So if we compare the previous quarters, revenue is down slightly, 33.6 billion to 32.1. Down, yes, and a similar story on the revenue for the year, 118 billion to just shy of 117, so pretty flat. The stock price in that time has gone down about 70%, but the revenue is still pretty strong and they're on the right trajectory after a bad few quarters. Next, we want to have a look at the profit. Actually, we'll go to the full numbers here because at the bottom it's a little bit easier. They just have the summary at the top. But we'll see how the revenue is broken down. We'll just look at the 12 months here for the sense of time. Cost of revenue is up. R&D is up quite a bit, 10 billion. They are spending a lot on their AI divisions, as Zuckerberg said in the statement before. Marketing sales is up a little bit, and general admin is up as well. So overall, the total costs are up from 71 billion to 88, which obviously brings the net income down quite a bit. 39 billion was what it previously was, and now it is 23. Earnings per share, obviously once down again, 13.99 to 8.63, and we're expecting that as well. But Meta is buying back their shares, 2.8 billion to 2.687. Why is that good, you ask? Well, because if there's 10 shares of Facebook, you own 1, you own 10% of the company. If Meta buy back 5 shares, there's now 5 shares, your stake as a shareholder increases, so you have more of the profits that are coming through. And Facebook is still profitable, not as much as they used to be, but they're still doing well. Now, finally, just as a quick summary, we want to look at the free cash flow. And the free cash flow is cash from operations minus capital expenditures. So the cash from operating activities, we've just lost that here because I've scrolled down. Where's it gone? Yep, cash from operating activities, 56.6 billion down to 50.4. And the CapEx, purchase of property and equipment they have here, is up massively, 18.6 to 31.4. So overall, I'll just find the free cash flow because they do actually have it on the sheet here. They have it at the top, down massively. Free cash flow for Meta was a major part in it, 38.5 billion, but is now down to 18.4. Reason for this, as we said before, the massive increase in the CapEx. Now, is that with a big expansion, are they putting in money? Is this going to create money in the future? But right now, I don't think the discounted free cash flow is going to like it. But let's have a look at my stock summary sheet. Market cap of Meta is 888 billion. They do not pay a dividend and they don't have a dividend date. Currently, it's not pulling through the data because Google is ignoring me. Sorry, it's Yahoo Finance I use for this. But if we look at what Yahoo Finance is currently saying, the PE ratio is about 15.7, which is less than the market, and that will be changing quite a bit. Will be increasing because it's now up to $180 a share, up 20% after market. That is crazy. What a return for Facebook. Revenue in the last 5 years is up 70 billion, sorry, to 116. Profit is up, shares are down, which you want to see, and increasing free cash flow. They're not increasing the free cash flow. So currently that gives Meta a very high free cash flow ratio of around about 50. Now, if we go to the discounted free cash flow model, I have a sneaking suspicion that it will not care for this one bit. Let's just have a look. We can see, oh, unfortunately here, the shares outstanding is not working because Google is down. Oh, what a shame. So the free cash flow, we know it's not going to care for it. All of Google's sheets are down. There's a problem with my sheet is broken. But what this was going to give you is a side. Let's actually add the numbers in here. The actual share price of Facebook is around about $180 a share. And the shares outstanding is where we had the number at around about 2.6. So let me just add that in there. Oops, a daisy. God damn Google breaking my video. The actual stock price is 150 at this point. So it has a calculated stock price of around about $100 a share, which is obviously not great. Now, this is because of the decreasing free cash flow. If we look at the numbers, you can see the average free cash flow rate is about 90%. Revenue growth rate is slowing, but analysts are expecting higher growth in the coming years. So that is a good sign, but it's not the growth we were seeing. If Facebook, well, I keep calling them Facebook, if Meta was there previously, you could see that number is actually getting a lot closer to that, but it's still a bit far away right now. So discounted free cash flow model doesn't like the stock, but you could tell it wouldn't originally because of the very high free cash flow ratios Meta currently has. Now, the other thing we look at is the Buffett-Graham intrinsic value model. As you know, Google has broke my sheet, so we'll get the share price of what it is currently, which is $180 a share. So let's put that in there. The expected growth rate, now this is very interesting. Facebook and Meta statistically have been a very positive company in terms of growth, but analysts are saying about minus 17% for the next 5 years. So we'll put that into the sheet, and you can see here we've got that. The bond yield currently, let's have a look at the AAA bond yield. It is currently 4.4, so we'll also add that. What does that give us in terms of the Buffett-Graham valuation? Minus numbers, because it is a minus expected growth rate. Now, I don't think Facebook is going to be like this. Obviously, they've been growing at a much different rate. If we take a more positive approach, say it was about, well, let's say it stays at about 2%. See, that would be fairly valued about 150. If they grew 3% over the next 5 years, it would be 180. So it is quite a difficult one, as you can see. But if Facebook are going on their current trend, then it's not going to be too good for them. But if they are able to be the year of efficiency, as Mark Zuckerberg said at the start, then potentially they can be more value. But for people who have bought Facebook at the bottom, I think it is a great sign for them because the stock is up over, well, probably 80% now. Is this the right time to buy? Only time will tell. Right, guys, first video back in a while. It's going to be rusty, as you can see. Wasn't expecting Google to break like that. Hopefully I will be back, and hopefully we can continue doing videos and providing content for you guys. Bit sad that Google Finances broke, but thank you for watching. Please give a like to the video, and the next video will be better. I'll catch you guys next time.